So, a couple things here. Let's first look at this, the supplemental values. Isn't that better? Yes, it is. So here is the custom fund. Annual net outlay, 90,000, 1 and 2, and then 50K per year, 3 through 10. Remember earlier when I mentioned in my early days, people I worked for said, just print the 2 pages that we can just show the numbers, then make it easy for the client to understand. That's what they wanted to do, which I get, but then from a compliance standpoint, it's like, okay, we're not supposed to do that. And now you start to think, how do I do things right? How do I remain compliant, but also make life easy for the client? I'll show you how in a second. So this is often what I like to discuss. Mention the fact that it is based on the present dividend rate. Here's what I will always mention is whenever we're looking at illustrations, when I have found them to be accurate, is looking at them on a yearly basis. For example, this illustration was produced in 2023. MassMutual's dividend interest rate for 2023 is 6%. Next year, the dividend rate could change. Other things could change. When we look at an illustration, the values will likely be different in year 2. So what we want to do is produce an in-force illustration to see the accurate values in policy year 2 based on the dividend rate that year and what we have paid into the policy that year. Where I have seen illustrations based on the supplemental values accurate is really year to year. We've had more cases than I can count where a client had a plan like this, paying $90,000 in the first year. The illustrated cash value was this, 79 and change, and it hit exactly that. The next year, however, we needed to run an in-force illustration, and then the values hit exactly that. The original illustration became a little bit inaccurate because things have changed. So illustrations are often most accurate year to year, just when we track the actual payment compared to the actual values based on the annual statement in the online portal for the client and also for us as the agent. And what I'll add here is in a case like this, where I see the illustrated values hit the actual values, like they're consistent, is when the premium and PUA payments are made all up front, because that's what the illustration assumes. If you're working with a company with a flexible PUA rider and adding PUAs at discretion, the illustrated value will be a little bit different from the actual value because the company begins to apply the guaranteed rate and any dividends on PUA payments based on the month that they are deposited. So it's good to be aware of that. All these small little rules and things you've got to be aware of, right? So back to this, we've got the actual funding here. This is what the client wants to do. This looks pretty good. There's my break even. Almost year 4 in this example, year 5 technically. But what about the guarantees? So the tabular values we don't want to show, and if we just run an illustration, it's going to look like this. Well, what you can do is run an illustration in the state of Texas, which in this case, we've got 22 pages with a non-Texas illustration. Texas illustration will be close to 40 to 50 pages without additional reports. The reason why, and this is specific to MassMutual, is when you run the illustration in the state of Texas, what will be generated is as follows. The supplemental values based on the present dividend rate, but then also the supplemental values based on the guaranteed rate and the guaranteed charges, call it the guaranteed values, and then also a midpoint assumption as well, which is a dividend rate assumption in between the present dividend rate and also the guaranteed values. Also with the charges for riders and PUA riders and term riders, the expenses on the midpoint assumptions will assume middle of the road charges, not the current, a little bit higher, but not as high as the guaranteed charges. Does that make sense? Hope it does. Thankfully, this is being recorded. So let's take a look here. I'm just going to jump to the supplemental values, the supplemental guaranteed values, as we ran the exact same illustration here, but in the state of Texas. Here we go. So what I would show is the full illustration from before, and then I would include a Texas illustration but I might pull out the number pages. So I'm going to provide the full illustration, but then pull out the pages too, because I don't want to send them a 50-page illustration and say, look at this page. I'll provide it, but then say, here's the number pages. And here we go. Now to do this, to actually run an illustration like this, you do need to know how to work the software or have someone that does know how to work it, because the supplemental guaranteed values do assume that the renewable term rider increases beginning year 2. So what we did to produce this illustration is take the amount every year that the renewable term rider premium increases, and then we reduced the AILR premium by that dollar amount in order to keep the net out of pocket where the client desired it to remain. So if we had a case where I actually put this policy in force, and let's assume in year 2, Mass Mutual says we are increasing the renewable term rider premium to the maximum allowable charge. What would happen is I would get a notice from them saying, if your client pays that $95,000 amount, go back to the tabular values, the policy is going to MEC. What I would do is reduce the AILR by the $5,000, so their net out of pocket is still $90K. And in the event that the charges do not increase again the next year, or let's say perhaps they go down, which is unlikely, but if it does, well, then I know I can increase my LISR a little bit because I've got plenty of 1-year term attached here. So again, it's really just knowing, call it the rules of the game, how to navigate through a life insurance policy, the software, knowing what changes can be made, what paperwork to file. And if you're a newer agent, or if that's something that you or your agency struggles with or could use support with, we do have some programs available. We've got our virtual training business. We do have a consulting business as well, but we only take on a small number of clients per year, just because that's more of me providing one-on-one attention, and there's only so much I can do. But supplemental guaranteed values allow me to see the actual guaranteed values with the numbers clean. Very valuable information. All right, so going back, that was the plan. That's how we modeled, based on what? Guaranteed values. The tabular had to show it. It was a bit wacky, but it was in the full illustration. The supplemental values based on the non-guarantees, well, that we showed because it was in the illustration. And then we had to show, here we've got a custom guaranteed values report, but it's just the supplemental guaranteed values by running an additional illustration in order to provide that convenience to the client. All right, let's next take a look at the husband. Different company here. Got good old Guardian, one of my favorites. I like Mass and Guardian. But with them, we're looking at an L95 policy, which means what? How long are premiums payable for? Up until age 95. So when we look at the tabular values, what's going to happen here? It's going to show premiums paid up until age 95. Age 94 will be the last payment. I'll show you in a minute. The other item we want to be aware of here is that the plan is to do this. Fund the policy, $90K, years 1 and 2, and then $50K, years 3 through 10. You probably guess that these two are a couple, very nice couple at that, but they're splitting the funding between the two of them. As far as the policy funding is concerned, same thing with diversifying companies. But that's the plan here, what they want to do. Let's take a look at the illustration and progress through the same thing we just looked at. So Guardian, with their illustration software, they've done, in my opinion, a fantastic job with it and the additional reports you can run. So here we've got a full illustration. You can scroll down a bit here, and we can just click to the pages we want to. I'm going to scroll down so we can see everything, and here we go. So what we have first, supplemental numeric report. That custom guaranteed values report is this with Guardian. This is a box we have to check under other additional reports. But let's keep going down. We'll go to the next section, tabular details. So this is going to be included in illustrations you produce no matter what with Guardian. Any life insurance company, the tabular values have to be included. So the planned funding was what? 90K 1 and 2, 50K thereafter through year 10. Let's scroll down here. So here's our base premium. We get this policy maxed out for cash value. That's the goal here. And the death benefit for them. But as we look at the guaranteed and non-guaranteed current values, current represents current dividend rate for 2023, 5.75%. What do you notice? The planned funding, both on the non-guaranteed and guaranteed values. With Guardian, we don't have a renewable term rider. We've got a 1-year term rider attached, which is like Mass Mutual's LISR, meaning payments we make satisfy the cost of the term rider first, and then the rest are allocated toward PUAs. Plan was to do what though? Fund for 10 years. What happened? We funded for 10 years, but then we see this dollar figure, which is this guy, 81.82. The base premium is constantly billed. After funding for 10 years, what I would absolutely do in this case, if at year 10 they said, we don't want to pay anything, we want to do exactly as planned, we would cut the term rider, remove whatever left, and we would even look at a reduced paid up option, which would eliminate the base premium altogether. So even if I wanted to pay it, I could not. Now, there's pros and cons to that. So we would look at it before exercising it, making sure that the client's fully aware of what it does and that they actually want to exercise it. But my point is, we would look at that, which would eliminate the premium here. But more importantly, the term rider reduction is important because when working with a 1-year term rider, what happens is the costs continue to increase. And based on the guarantees, they really go up. So in a case like this, if we scroll down a bit, we see that the policy just implodes. Kind of like what you'll see with some universal life insurance policies. But what happens, why it blew up, meaning the death benefit just shot down, is because the term charges became too high, and that's my whole life policy. But what happened before that, look at my cash value, starts to go down. Now again, this is a very, very easy fix where we would just reduce or remove the term rider altogether, and it's a non-issue. We would do that after the funding. We could do it earlier, not before year 7 or year 8. The first 7 years, we don't want to do it from a MEC test standpoint. But after that, it's easy to remove, and we've never, ever had an issue with it. But this can cause confusion. I have been asked over the years, why do the guaranteed values go down? Is this what can happen with my policy? Well, the answer is yes, if we neglect the policy. I like the word neglect in this case because it would take neglect. Let's go down to the ledger statement, which is the same as the supplemental values, the custom fund scenario. So what do we have here? There's your 90K, there's your 50K, and then 0. Exactly what the client wants to do. There's your base premium. Look what's illustrated here, reduced paid up at the beginning of year 11. Side note, reduced paid up, term rider reduction, any of those changes. So if this is the client's plan, let's say they actually exercise reduced paid up in year 11. When we submit this illustration to the life insurance company, say they do exactly this, that reduced paid up will not automatically happen in year 11. We have to actually make that change at that point in time. So I would always file your illustrations as far as what the final plan is or really what the client wants to do. Things will change over time, but keep that on file and have a note in your CRM or in your system that brings up a reminder, reduced paid up is going to be considered at year 11 or every year after year 7, whatever it might be. This way we don't forget or it doesn't slip through the cracks, especially if something happens to you, another agent takes over, they have the awareness. It's very, very important. So here we go. Custom funding looks great. However, what about the guaranteed values? Well, with Guardian, we can select that additional report, supplemental numeric, and there we go. Now what do we have? Look at that. Much better, isn't it? So the supplemental values reflect any changes, any custom changes we add in the illustration, which in this case, an RPU at year 11, which cuts the term rider, eliminates the premium, which is why I have 0 out of pocket. And how you can tell just from looking at an illustration quickly, so this is an L95 with premiums payable up until age 95. Once we go reduced paid up, what happens with the death benefit? Doesn't go up at all based on the guarantees. If you're ever looking at the guaranteed values of a life insurance illustration and you don't have a 1-year term masking it, if you add PUAs, the death benefit will go up. If you pay just the base premium, or if you exercise a reduced paid up, the death benefit will not go up. If you exercise a premium offset, which allows the dividends and interest to pay the premium for you, in many cases based on the guarantees, you'll see the death benefit go down. So good to be aware of that. Perhaps good to look at some illustrations too, just to master the game. And all of this, you don't have to go over all of the details with the client regarding everything we're talking about. I don't, because again, I want to make things very, very convenient for them, but at the same time, follow compliance guidelines. I don't want to do anything to mess up. There's the non-guaranteed current values, which will match the ledger statement we looked at. Very nice. So all of that's really cool. What I also like to look at from a simplicity standpoint, something like this. There we go. Which has everything side by side. So we've got the husband with Guardian, the wife with Mass Mutual. These values are pulled directly from the illustration we just looked at. There's the combined values. And of course, making sure we're providing all of the full illustrations with this. But I do like this because it just makes life a lot easier. And in a case like this, what I'll also add is this is based on the dividend values. For this particular case, what we also did was highlight the guaranteed values. Because what I like to do is this, because if we go back to those supplemental guaranteed values, it did not have a total payments column. Total payments of $580,000. There's your break even between 11 and 12. Mass Mutual, with that low 2% guaranteed rate and the higher expenses, look at that, between years 28 and 29. And if you go to the non-guarantees, well, it's a lot better. But this does make it a bit easier. And also, I like to show that stuff. I've seen this occur in the industry where when something does not look as attractive, don't show it, right? Hide it. No one says hide it, but it feels like a game where it's being hidden. And I'm not a fan of that because think of it this way. If this is you're this individual, or this is your policy, and you take out a policy because you like what you see on the non-guaranteed side of illustration, and maybe it even happens, or the values are very, very close to the non-guaranteed. A year or two after you purchase the policy, someone gets in your ear and convinces you that you really should have looked at the guaranteed values, regardless of what your agent tells you. Let's say I'm your agent. Regardless of what I told you, someone gets in your ear and says, hey, did you look at the guaranteed values? Oh, very important to do that. It was someone that you trusted or you trust very much. Do you request the guaranteed values? And then you see 10 years plus, 20 years plus with the Mass Mutual product, there it is. My goodness, what's going through your mind? What, did I get ripped off here? What's going on? Now we go back and forth. No, not to worry. When we look at the performance here, we see it always perform very closely to the non-guarantees. We measure it year over year and try and provide peace of mind again. But how much easier would that have been? And how much more would you, the consumer, have appreciated it if you saw everything up front? That's the big thing. So from an educational standpoint, it is beneficial, this is my opinion, to look at the worst case scenario up front. Look at both. I've noticed when we've worked with individuals paying in 7 figures to policies, I'll show those worst case scenarios every single time. And one case, as I reflect back on it, I was very fortunate to have shown that because the couple had brought in an attorney who was firing a lot of questions at me. I've shared this story before, but firing a lot of questions, asked about the guaranteed values, and fortunately we had already looked at them, so I pulled them right up and said, here's the worst case scenario, here's the present dividend rate, here's midpoint values, and after that, during that call, I could sense that the tension just kind of calmed down because that attorney was protecting her clients from an insurance agent she did not know, and she wanted to make sure that someone was not trying to sell them a high commission product, which she had seen occur so many times. And I'll tell you, I hired that attorney afterwards too for a number of reasons, and her and her firm are very good at what they do. But that's unrelated. My point is, those worst case scenarios, no matter how much you feel they're unrealistic, they are beneficial to show from a compliance standpoint. We are supposed to show them. I would always include them, but don't try and brush over them either. Always highlight it, whether you spend a lot of time on it because your client has a lot of questions, or if it's a short amount of time. What I'll add, and I'll close with this, is historical performance is very, very valuable as well, because the guaranteed values display something that's not attractive. However, if you can show that policies have actually delivered over time, meaning historical, or we can call it actual performance here, meaning what has the cash value, what has the death benefit actually done over time. So when I compare the illustration with reality year over year, what have things looked like? That goes such a long way. I know for me, it's a huge selling point. I learned about this, or I should say when I was exposed to it heavily, was my days working at an executive benefit planning firm. Picked up a lot of knowledge and experience there, where when working with corporations, this was always discussed. And with the major mutual companies that were being considered, so Northwestern Mutual, always bring it up. So then naturally, I would question Mass Mutual, Guardian, New York Life on occasion to try and get information from them to see actual policies. So we have some older policies that were started before I was born. But then at the same time, as I've been in this business now for more than 10 years, what I like to do is the same thing with policies that we've put in force. What has been the actual performance? And we've seen them deliver attractive internal rates of return on the cash value and death benefit, measuring the adjustment in the dividend rate, and see exactly how that has impacted the internal rate of return. Tell you what, my favorite case studies are those situations where someone plans to pay in a certain amount of money for a certain period of time, and they do exactly that every single year. Because it makes it very easy for me to look at an illustration as far as what was originally shown and then compare it with what's actually happened. That becomes challenging is when someone adjusts their payments and pays different amounts in over time. You can still review the actual performance in a case like that, but you can't compare it with the original illustration because the funding differed. In any event, I hope that this was helpful. I know we covered a lot of material there, and at the same time, there's a lot more material in life insurance illustrations that we want to be aware of as the agent, and some of your clients will ask you as well, especially if you're dealing with analytical individuals or corporations. Perhaps a CFO is asking you a lot of questions. It's good to have awareness on these different items or life insurance illustrations in general, and then also know when not to talk too much, right? When to keep things convenient for the client and such, something that I've struggled with a lot over the years, but I'm always working on. So I hope that this did help. Let us know if you have any follow-up questions at all, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.